Hey everybody, Courtney Smith here with our weekly video newsletter, TradeSmith for March 21, 2016. And if that wasn't exciting enough, then let's talk about this, because this takes my excitement to the edge of a cliff. It is that exciting. Let's carry on. Okay, things are getting pretty interesting. Now, what I've been calling for weeks now, maybe a month, I don't really know, was first I looked for a rally up to the 2000 to 2020 area, which is where you can see that horizontal green line down underneath the red squiggles, all right? We've now passed that, which means that our next objective should be up near the top green bar just under 2120. Now, you notice I put all those red squiggles. The reason I put all those red squiggles is because this rally could really stop anywhere in that squiggly zone, because you can see there's lots and lots of highs in that area. So really, we're getting close to what I think will be the high of this really quite explosive move that we've had. Now, one thing that suggests that we can keep on moving is the purple line. And the purple line is accelerating. The purple line is the on-balance volume. It's actually a pretty good indicator of what smart money is doing. And you can see that the smart money is coming into the S&P and pushing it higher, even though we've been really moving higher for almost 2 months. Now take a look in the lower right-hand corner, and you can see that on Friday, even though it was a little teeny range, it occurred on heavy volume. Now let me give you the bullish interpretation. Rising volume in a bull market is bullish because it confirms the bullishness. It shows that the urgency is in the hands of the people that are bullish. They're the most urgent. They're driving the stock market higher. But I also have to tell you, I'm a bit nervous when I see high volume and such a narrow range day. Have we run out of buyers? Is this actually a sign that we're near the high? So I hate to be weaselly here, but this could be interpreted as either really bullish or really bearish. Now that's the bad news. The good news is it's probably bullish. And the good news is we're going to find out on Monday or Tuesday anyway. So it's all going to be resolved very soon. Either we have a sharp down move or we continue to bull higher. And that's what the volume is telling me. But very fascinating. Given the on-balance volume, the purple line, I'm going to take the bullish bias for now, but my eyes are open to a potential big reversal to the downside. Let's take a look. Dow Jones accelerating to the upside. Look at the on-balance volume skyrocketing. And once again, we have that really interesting volume pattern that the last 3 days are seeing increasing volume. So normally that would be bullish. NASDAQ, similar situation, not as quite as bullish. The action is over in the big industrial boring stocks. Same big volume though. Seasonality, change here. We just broke to new highs on the IWM, which is our seasonality indicator, which is bullish. We're on a bull signal right now, which means that we're taking extra large positions. I would recommend taking 50 to 100% larger positions than you normally would, because we have seasonality at our back. Now that green line is my reversal point. If it breaks below that green line, then I'm going to put it back on a bear signal. Now, up until Friday, that green line was all the way down at the bottom of the chart. So I'm moving it up quite aggressively. Why? Well, normally seasonality ends at the end of April. So, that's about 5 weeks away from now. But we always want to be alert to the possibility that seasonality ends early. So I'm going to start to get a little bit more aggressive at moving up my reversal point. And so that's what I've done. Now, let's not forget, the summer is not bearish seasonality, it is neutral seasonality. But when the market is neutral, that is to say going sideways, we still don't want to even have normal position size on. We want to go to half size positions. So right now I'm saying officially I'm taking 50% larger positions. If it breaks below that green line, closes below the green line, then I'm going to go to only 50% of normal positions. But right now, it's helping us make a lot of money right now because our positions are bigger than normal and most of our positions are making really good money. Seasonality, this is from Stock Traders Almanac, highly recommended. And all election years, this is their seasonality, is the blue line, which is just generally bullish, moderately bullish, no big deal. Let's not get excited. And that's the one we should be focusing on the most, is that the blue line, which is election years. And election years tend to be moderately positive for the stock market. So that's where I'm going to go. Maybe next week I'll explain the other two lines. Seasonality of utility stocks is bullish. Guess what? We're long and strong, the Utes. And not only are we long and strong, but we're making really good money from being long, boring utility stocks. But right now, the market loves the high dividends. It's piling money into those Utes, those utility stocks, and as a result, they look a lot like some high-flying stock like Google or Facebook or Alibaba. The yield curve, I'm going to not to talk too much about it this week, but it's starting to be a little bit better. Asset allocation. This is showing that the big institutions are shifting money out of bonds and into stocks. And of course, that flood of money is why we're seeing the stock market move higher. It's also why we're seeing the bond market move lower. We'll get there in a minute. So basically, they like taking risk in the stock market. Sorry, here we see our risk indicator going up, which shows that they're getting frothy, that they're going to start moving into technology stocks and crazy things instead of utilities and consumer staples. Those still, up till now, those utility stocks, well, you'll see. They are awesome. I'm sorry, you'll see if you're a fully paid up member. If you're a freebie, sorry, you won't be able to see it, but you can go to your chart service and you can see it over there. Global shares doing very well. This is something I've been focusing on a lot over the last several weeks, and I think this is a great place where you can make a lot of money. We've got a great bull market in the U.S., but we've got some really good bull markets going on overseas. This shows pretty much all the world. But look at Australia. This is really strong price action. As soon as the market thought that maybe China wasn't slowing down as much as they thought, and once the premier of the country said he was basically guaranteeing 6.5% to 7% growth, Australia has been on a tear. You've got to be trying to find ways to get long Aussie stocks. Another one. This is one that we can get in right now. So if we break that green line to the upsides, I'm going to get long Japan. I'm going to get long Japan by buying EWJ. EWJ. That's what this chart is right here. So here we've got a very good potential opportunity to be a buyer of Japan. It hasn't run away like Australia has. How about Spain? That's a nice bull market too. Breaking out on Friday, we had a little 2-day dip, and now we're starting to move back up again. France, similar picture, only even more bullish than Spain. Awesome. Got to be involved here too. Now, the one I've been really hyping is Greece, and it kind of peeled over on heavy volume on Friday. So I'm not long Greece, but my opinion is starting to change that maybe it's not going to be as good as I was hoping it would be. Bonds, very interesting. The two red lines are what's called a descending wedge formation. And it's confirmed by the fact that the volume down at the bottom of the chart is declining as the formation is being developed. And that means that this looks like right now a legitimate declining wedge. A declining wedge is a bullish formation. Now, I've been talking up a bearish case. On the next slide, I'm going to show you a bearish case. But in the final analysis, price is the most important indicator, in my opinion, is worthless. So this may be setting up for a very interesting pop to the upside. Now, how do we play it? The way you play a descending wedge like this is you wait for it to break out and above the top downtrend line. Now, if you got out your microscope and peered very closely at Friday's price action, you would see that it poked its head up above the declining top line. It didn't close above it, but it poked its head up there. So what I would say is officially, if it closes above that top downtrend red line, then I would say the formation is completed and we should expect a rally up to 135 on the bonds, from about 130 to 135. That would be a nice trade. And I'd like to see it on heavy volume. So that would be the best possible situation. So we're very, very close. Maybe Monday, maybe Tuesday, we'll see that breakout. Bond key factors, all pointing higher. This suggests that interest rates should move higher, which means that bond prices should move lower. And yet the price action is suggesting quite the opposite. When in doubt, trade the price, not the indicators. The dollar, this chart looks like the same as last week. Declining sharply, going down to the bottom of the channel formation at about 9,400. Probably get down to a little above that, and then we'll see a significant rally, but still in the context of a sluggish bear market for the dollar. This is a bit surprising to me because I think there's a lot of bullish fundamentals out there. But once again, price trumps all. Gold, starting to worry here. As you know, I've been a big bull. I own a lot of gold right now. But notice we've got a big divergence here. The prices are going up. That's the top upward slanting trend line. But look at the green line. That's RSI, and it's making lower highs. And that divergence tells me that the price should sell off. Now, the only good news is we might have already had the sell-off. Look at the price action at the end of the previous week and the beginning of this last week. You see how we had a decline from 1280 down to about 1225? That could have been the divergence being taken care of. Going to take us a couple of days to confirm what I said, but it may be that the divergence is over and we got an all clear sign to start to make higher highs. Right now, for the first time in a long time, all of our indicators are bullish and suggest that we're going to see a new bull leg in gold. And that's my best guess. My best guess is that the divergence has been handled and that this chart is the dominating chart and we're going to see gold move higher in the coming week. Another factor bullish for gold is the Indian rupee is on a tear to the upside. And the stronger the Indian rupee, which is the currency of India, is, the more bullish that is for gold. Okay, oil, it's a bull market. We're making higher highs, we're making higher lows. Now, fundamentally, and so technically this is all clear to the upside. But fundamentally, there is the potential to turn on big increases of oil into the market again. They kind of backed off a little bit, but they could come back on stream and we could see new downside pressure. So I'm not going to get aggressive on the long side. In fact, I still don't really have any energy stocks long or options at this point because I just can't get over the fundamentals being bearish. But we always have to look at price. Price is a bullish story right now. Hey, all you freebies, love having you around. But if you actually want to become one of the elite fully paid up members, that's the website to go to up at the top. Just sign up right away, and then next week we can get you into the cool kids section of the cafeteria. But for now, that's it for this week. I'll talk to you next week.